So this is going to be our final session of the day. So for this session, the format is a little bit different. We've got 4 papers, no discussants. So these are 4 sort of very policy relevant topical papers. The format is going to be, so 15 minutes for the presentation, and then we'll have 5 minutes for Q&A. So without further ado, let me just give it to Aymeric, who's going to be talking about PACE loans.
Thank you. Good afternoon, everyone. It's a great pleasure to present this paper. It's one of its first time it's being presented at the conference. So it's a joint work with Cameron Lapointe and Francesco Mazzola at Buisson. So today we're going to be talking about PACE loans, which are loans that aim at improving energy efficiency and climate resiliency of houses. So before going into the subject, I would like to provide you a bit of motivation. Why do we care about PACE loan? So the answer in one word is climate change. So climate change is going to require a lot of investment to reduce CO2 emissions among residential housing. Why is it the case? Because housing accounts for a very large fraction of global energy-related emissions. So according to the IEA, it's equal to 20% of global energy-related emissions. And if you think of the amount of investment that is needed just to meet the Paris Agreement of net zero by 2050, we actually need to multiply this the total investment we have currently in real estate by 30 to reach this target. Another way of saying it, why we need to increase investment in projects that aim at mitigating and making home more resilient to natural disaster, is that homes are impacted by natural disaster. This leads to an increase in risk premium, and you want to make home more resilient. So we are going to study a new class of financial contracts which aim to reduce this investment gap: residential property assessed clean energy PACE loans. And they have like 2 characterizing features in this loan, is that basically a household can borrow some money to pay for a project that is for home improvement project that is going to improve the energy efficiency or the resiliency of their home. And they will repay this loan through the property tax bill. And this PACE loan has generated a substantial amount of policy debate. So you have like to summarize a bit this debate, you have like 2 different views. You have a first view that is held by the Consumer Financial Protection Bureau that say that these PACE loans are increasing the risk that the household sector is taking. Why is it the case? Because this type of PACE loans are subject to lax screening. They are also exempt for regulation that are put in place against predatory lending practices. And also an important feature of this loan is as they are backed by a tax lien, they breach the priority of traditional mortgages in bankruptcy. And then the second view is saying that PACE loans are a necessary tool because it allows financial constrained households to invest in projects that improve their home equity value. So in this paper, we're going to run some tests that are more consistent with the second view, where PACE loans are actually projects that reduce financial constraints that households have. So more specifically, we assemble like a new data set that is very granular, and we find like 4 core results. First, households that appear ex-ante financially constrained are more likely to use PACE loan. Secondly, we find that the projects that PACE loan finance really increase the home value. So we find an increase in the house price after a PACE loan equal to 35%. On the other side, PACE loans significantly increase property tax delinquency rate, which it makes sense. Now households have a higher repayment. So at the margin, like property tax delinquency rate should go up. And we don't find evidence of a crowd-out effect of traditional mortgage lending. We found, on the contrary, an evidence of a crowding effect. And then we try to make sense of our economic magnitude. You did this simple formula where if you take the perspective of a local government, PACE loan is going to be good because now house prices are higher. So this means local government will have higher property taxes, and this is this term. But on the other side, more households now are bankrupt on their property tax payment. So this is a cost that will be borne by local governments. And when you put these two estimates that we have in our empirical section, we find basically an increase in local government revenue by a bit less than $700 per PACE loan year in counties participating in the program. So you can think about these loans as a way to improve the climate proofing of the housing stock and at the same time increase the revenue base of local governments. Let's skip the literature review. So what is a PACE loan? So these are loans for qualified energy efficient and climate proofing home improvement projects where borrowers pay debt through annual local property tax bill. And I think there are like two important words that we have highlighted. The first one is you cannot use a PACE loan to finance any project. You can only use it to finance a specific set of projects whose goal is to improve the energy efficiency or the climate proofing of your home. So it could be, for instance, some impact resistant windows, or if you want to put or to do a re-roofing, but you can also use it to finance a solar panel installation in your house. Why can you use this type of project for energy efficiency and climate proofing projects is because sometimes the two are highly correlated. So if, for instance, you put some impact resistant windows, this is going to make your home more resistant to natural disaster, but at the same time, your home will be more energy efficient. A very important detail is that local government will act as a local loan servicer, and this means that the lien that is backing this type of PACE loan is actually a property tax lien. So this means that PACE loans are breaching the rule that you are the first in time, you are the first in right in bankruptcy. So even if you have some pre-existing mortgages, this mortgage will become junior to the PACE loan after a PACE loan is, even if the PACE loan is taken later after the mortgage issuance. So in practice, how this works is going to be a public and private partnership where local governments are going to issue bonds backed by tax payments and also the underwriting to private lenders. So this asset class is extremely growing. Like 15 years ago, it was inexistent, and now it is reaching in 2022 $8.5 billion in total origination. Residential PACE is available for 3 states, California, Florida, and Missouri, and we'll focus on Florida, which is one of the biggest segments of this market. So we assemble like a new data set of 16,000 property level loan match using the assessor parcel number to a traditional commercial, traditional real estate database that I will not have to explain because I know you're all familiar with this data. So we use another data, we use the Shelter's natural hazard data to have information on natural disaster losses at the county level. So first, we start the analysis by showing some basic descriptive statistics. Who are these people that take this PACE loan? And we compare people that have a PACE loan with people that have a HELOC loan. And why we do so is because if you want to make a home improvement project, either you can use a PACE loan or a HELOC. And when you just compare the descriptive statistics between these two groups, it is consistent with this idea that PACE properties are more financially constrained because they have smaller property size, they are older, they trade at lower value, and they are more likely to be tax delinquent incentive. And this simple descriptive statistics point to the financial constraint study. Then we try to understand what explain this take up in PACE loan, and what we do in this graph is we basically show that participation in PACE loan is very sensitive to whether you have some hurricane in your area. So here we focus on the Hurricane Irma, that is one of the biggest in Florida, and also it happened in 2017, which is right in the middle of our sample. And we show that after the PACE loan, you have an increase in participation among in counties that are more heavily hit by Hurricane Irma. Okay, so now we're going to look at statistics that are very important for local government, which is what is the cost that PACE loans are going to create for local governments, and what are the benefits. So the cost we have in mind is like property tax delinquency, and the benefit is like house price appreciation. So here what we do, we compare we do like a Bayesian analysis because participation in PACE loan is very selected. So we compare properties. So we compare properties with a PACE loan And we do our tests within properties that have a base loan, and we expect the fact that participation in the program at the household level is staggered. And we regress like the log of the price on a dummy of whether the property has a base lien, and we add some controls and fixed effect. And what we find is that a large house appreciation once a property has a base loan, which is consistent with this idea that the projects that base loan finance is really creating some value and is really improving the quality of the house, because then people are more likely to paying this house at a higher price afterward. At the same time, base loan is also increasing the delinquency, the property tax delinquency rate. So here what we do like a within estimation, and we show like the property tax delinquency between people with a base loan with those that do not have a base loan yet. And what you find is that a strong increase in delinquency after a base loan is being taken. So then we try to make sense of these estimates using this simple formula. And we plot like the capitalization effect that we find in our analysis. We subtract from revenue loss, because when a property is tax delinquent, this is a loss of revenue for the household. We make some very strong assumption. So we find an estimate that is a bit less than $700 per base loan a year in counties participating in the program. And this is a lower bound because we take some very conservative estimates. So we take some very conservative assumption when we make these estimates. Why? Because we don't account for local employment or non-base investment that are also going to affect this cost and benefit analysis. We don't put a value of the pecuniary benefit of reduced environmental externalities coming from a base loan, and we make the very strong assumption that 100% of the delinquency costs are borne by local governments, whereas in practice you have some risk sharing with the bondholder. And with this very conservative assumption, we still find a positive impact of base loan. So then in the third step, we try to understand whether we have some crowd-out effect when a local account, where a county is adopting a base program. And this is a concern that many policymaker has in this debate. As base loan are super senior, people were afraid that this will like reduce the supply of mortgage. So we try to formalize a bit this intuition in a very simple model where you have like 2 periods. And in the second period, you have some random income shock. If the household has not enough income, then the household is filing for bankruptcy. And base loan, if you add base loan to this model, what this is going to happen is going to increase the probability of default. Why? Because now debt to income is higher, the default ratio is larger. On the other side, the recovery value of the house might be higher if the base loan allows the household to finance a project that is really increasing the value of the house. So if you have a house with no roof, and now you put a roof, the collateral value is going up. So we show that basically the impact of base loan on the ex-ante supply of mortgage really depend on what is going to be the base loan impact on the collateral value. So we show in the within base regression that this price effect was very strong. So then what our model predict is that we should also observe a strong supply of mortgage in counties that adopt a base loan. So to run this test, we basically exploit the fact that participation in the base program in Florida happened in a staggered manner. So we collect the entry date using some freedom of information act request and some collection in local news sources. We show that the specific timing at which counties join the base program is conditionally random. It is not predicted by several characteristics. And then we run the regression, we look at the supply of lending using HOMDA data, and what we show, we don't find any evidence of a crowd-out effect. On the contrary, what we find, if we find evidence consistent with the crowding effect, the supply of mortgage when a county adopts a base loan is increasing, consistent with the view that now the value of the collateral is higher because households are less financially constrained and able to invest in projects with high NPV. So to conclude, we show that local government-backed loan can help close the investment gap in green residential projects. And it's kind of a win-win situation because on one side, you create some tax revenue for local governments. On the other side, you also make the housing stock more climate proof. Then we saw that the super seniority of tax lien does not lead to product effect of traditional mortgage credit, which is one of the main concerns that kind of prevent the development of the base loan market. Thank you for your attention.
All right, thanks. We have a few minutes for questions.
It's very interesting. I'm just curious, it seems like this would be a breach of contract for the traditional mortgage that's on the property that rules out any debt that's more senior to it. I know it seems like you're saying ex post it worked out for them, but like how legally, how is this actually acceptable and why didn't the lenders block it from happening?
Base loan, if the property has a base lien, but legally the base loan is going to be backed by a tax lien, and tax lien is super senior to mortgage lien. So this is a legal type of contract because it is issued by local governments, and it has and as you were saying, it has generated a substantial amount of debate of whether this breach of priority of the traditional bankruptcy rule, which is like the first in time is the first in rights, and this has generated a lot of controversial positions. Yeah.
Just to follow up on that question, you could imagine a Fifth Amendment taking suit resulting from that super seniority, and the rebuttal to the taking suit is the property value appreciation that you show. So in fact, there's less leverage ex post, and therefore the now non-senior lender is in a better position than they were before.
Exactly, that's on paper. Exactly, it's like you basically allow the value of the house goes up a lot, which means that at the end of the day, mortgage are kind of happy that the household was able to find a way to put a new roof after a natural disaster, or to install some impact-resistant windows that will help the house to go through the next hurricane. Yeah, that's exactly the point of the paper.
Yeah, in the back.
Hi, I'm Sharon Cornelissen with the Consumer Federation of America. My question is about consumers. So your conclusion says, well, these loans do more good than harm for municipalities, right? For their tax revenue, it's good for their tax. What about consumers? Like you're saying that these are given more to more vulnerable consumers that may not qualify for, a home repair product. What is the impact on them? Overall, yeah.
That's a good question. So you have like some redistribution effects. Some consumer will basically lose from this contract because they will be delinquent on their property tax payments. But some other are also going to benefit a lot because now they incur like some house price appreciation. So this is good. If you think that having a price that is worth more money is a good thing, then I think consumer will be better off. But so I think it's not, you have some redistribution effect, but without the specific utility function, how much households are going to value the fact of having a new roof is going to be very difficult to make some aggregate consumer welfare application.
Can I just follow up? It would be good to have a disparate impact kind of analysis there too, right? Like who benefits and who becomes delinquent on their property taxes. Right?
That's true. Yeah, we could do some more descriptive statistics to understand who are the population that go bankrupt and those that basically have the highest price appreciation. Yeah, that's a good suggestion. Thank you.
All right, I think we're gonna have to turn to the next presentation. Thanks, Aymeric.
Thank you.
So we have Jonah and Coste from the FHFA talk about lock-in.
Does this work? People hear me? If I do this? Great. There we go. There's a lot more in there. So yeah, I'm Jonah Coste. I'm with FHFA. This is joint work with my co-authors, Ross Batzler, Will Dorner, and Mike Seiler.
about the lock-in effect of rising mortgage rates. I'm not going to spend a whole lot of time defining that. I think Lou yesterday on our panel did a good job talking about it. These headlines sort of also give a pretty good sense of what's going on. I can't afford to sell because I don't want to lose that 3% rate. These headlines sort of generally reflect at least the understanding in the popular press of this phenomenon as of like a year ago or so. And you see it's anecdotal. There's some speculation about effects it on prices, keeping prices high. And to the extent that it's quantified, this is sort of the best we could do is saying, what percentage of people have rates below different thresholds. So that's sort of motivated our team to say, well, I think we can quantify this better. And we sort of got this into four primary research questions. One, how locked in are borrowers? How sensitive are sales to that lock-in? And what's the aggregate effect on sales and on prices? So I'm going to skip most of this literature. If you're interested, there's talks about other lock-in effects in finance and in real estate. Some other work on mortgage rate lock-in, including Lou's and Julia Fonseca's paper. And I'm also going to skip most of our model, which builds on what Lou and Julia did. It adds a rental sector, and that allows us to model some effects on prices. But the major predictions of the model are at, in a world with adjustable rate mortgages, changes in the interest rate shouldn't change your propensity to sell. So this rate delta is the difference between your fixed rate and the rate you could get in the market today. So now right now we're existing in this area here with negative rate deltas where market rates are well above what people have on their fixed rates. If you have fixed rate mortgages, though, you see this nonlinear relationship where increasing interest rates, so where you have these negative rate deltas, really decreases your probability of selling. And it's nonlinear because at a certain point, somewhere between +1 and +2, the benefits of refinancing exceed the fixed costs, and therefore you can benefit from the decreasing rates without selling, and instead just refinance. The other prediction that comes out of this is that the two regimes, adjustable rate regime and fixed rate regime, is going to have very different relationships between interest rates and prices. So this adjustable rate line here indicates sort of the conventional thinking that higher interest rates, so again, moving down to negative rate deltas, is going to be a negative on prices. But when we move to fixed rates, we see the opposite holds, although not as strongly, but that in the area where we had the decreasing propensity to sell as rates increase, you have increasing prices as rates increase. Once you get to the point where you no longer have an effect on the propensity to sell, then you revert back to the normal conventional thinking of a relationship between prices and interest rates. So to test these empirically, we use data from a 5% sample of US mortgages, NMDB, and we also use GSC data, which we're able to connect with property data. 91% of those loans were able to connect and be able to see which loans ended due to sale. So quantifying the lock-in effect, right? As I've introduced you this delta R measure in the theoretical sense, empirically, right, is the same thing. It's the difference between your fixed rate and the rate you could get at time t, which is, of course, is unobserved. So we model that by modeling people's fixed rates on a fixed effect and a time fixed effect and a series of borrower and loan characteristics. And then we are able to predict the rate that you could get by switching out the fixed effect and calculate your delta R. Now, there's some concern when we look at sensitivity to sales that this error term is going to be endogenous if you buy points because you anticipate to be around for a long time, or you have a higher search intensity for the same reasons. That could, will definitely correlate with your propensity to sell. So when we're looking at the relationship between sales and this delta R. We'll do it with this delta R, but we'll also use predicted delta R's, where instead of your fixed rate, we use your predicted fixed rate just based on your characteristics and when you originated the mortgage. So this is what over time the distribution of those delta R's look like. And you can see what going back to 1998, you can see we're sort of in a very unprecedented situation. And no other hiking cycle since 98 had more than 40% of people been even 1% locked in. Now we're in a situation where almost 70% of people are over 3 percentage points locked in, have a mortgage rate that's over 3 percentage points lower than what they could get in the market today. This is what that distribution looks like as of the end of 2023 across different types. The differences between these different mortgage types is not, they're small compared to, they're all very locked in, is the big point. 3.24 percentage points on average. That translates to over $500 a month and lower interest payments, or a 40% if they were to remortgage at current rates, it would increase their principal and interest payment by 40%. So very, very significant numbers. All right, so moving to the relationship between that and sales. Let me just check on the time. Okay, how we're doing in sales. So we battled this linear probability of sales. First, non-parametrically with the flexible function of the rate delta, a fixed effect that should absorb overall economic conditions, including the level of interest rates. What we find is very much like was predicted in the theoretical model. We see a very linear relationship up into a point, and then it flattens out. So we eventually parameterize to reflect that pattern. This is those non-parametric results. The blue circles are the observed delta R's, and the red squares the predicted ones. And yeah, we see linear pattern, it flattens out. Particularly once we remove the endogeneity, we see very flat up here. This is probably selection bias. If you're here, it means you didn't refinance when you could have, or couldn't, when theoretically you could have. And that's correlated with inattention probably in other ways, or dispropensity to move. But when we parameterize it, right, what we get is this slope here, which is interpretable as the percentage decrease in your likelihood of sale for every percentage point of lock-in, 18.1% in the more robust specification. As a placebo test, we look at ARMS, where the initial rate lock period has expired, and we don't see this relationship. If anything, we see it somewhat downward sloping. It's not statistically significant, but that could indicate that we do have some people who are forced to sell because their rate resets and they can no longer afford it. But very reassuring that we don't see this pattern when we look at rates, mortgages that don't have this the fixed rate feature. We do see some very interesting heterogeneity. I won't talk about it very much, but the two things that jump out are measures of affluence, in particular home values are higher levels of affluence have more sensitivity to lock in. 23, that 18% overall number jumps to 23 for homes valued above 600,000, only 13% for homes valued under 300,000. Somewhat counter to that, even in that absolute sense, but certainly once you control for affluence, non-white borrowers are much more sensitive than white borrowers, it looks like. So there's interesting stories with heterogeneity. One other point on this, you could do it as a positive that the most affected people are most affluent, and the people that are locked in. This is also, you can view it as a negative. Says less affluent groups have less ability to strategically time their purchases, and this could feed into overall wealth inequality. I'm going to skip this. This just takes the output of that model and says counterfactually, if we were in that ARM world or a perfect portability world, et cetera, if we remove the lock-in effect, what would sales have looked like over time? We would have seen, slightly, 10 to 15% more sales in this sort of in the post Great Recession period when rates kept going down, and so we had this, steady extra incentive to sell. But very similar until right now, where this gap right now is 57% of the average level of sales. We're seeing a decrease of 57% of the as of Q4 2023 in the likelihood of sales due to the lag effect. Or if you translate that into numbers of sales lost, we get 1.33 million over the past 7 quarters, including 269,000 fewer sales in Q4 alone. One thing that gets mentioned when I talk about this is, well, VA loans and FHA loans, they're technically assumable. How does that affect this? In all of 2023, the VA and FHA processed 5,600 assumptions. This is, we talked a little bit about this yesterday. There's issues with getting servicers. There's issues to do what they need to do. There's issues with the availability of second liens, et cetera. We're looking at hundreds of thousands of lost sales of this. So even if all those 5,600 assumptions were a sale that happened only because of the ability to assume, it wouldn't meaningfully change these numbers. And so finally, we said we want to look at what this does on prices. And so we look at MSA level quarter over quarter home price appreciation. And we regress that on aggregate rate deltas adjusted to account for the nonlinear relationship between likelihood of sale and the average origination interest rate over the quarter. And we'll focus on this last column here, where both are included and we instrument for both. And we see that every percentage point of lock-in, right? So which is a more negative rate delta. So the negative sign here on that indicates that is an upward effect on prices. So every percentage point of lock-in increases quarter over quarter appreciation by 37 basis points, while working in the other direction, higher interest rates decrease quarter over quarter appreciation by 18 basis points. So you might you apply those estimates to the rate paths that we've seen since the rates started rising in the spring of 2022, and it translates to 5.7% upward pressure due to the supply reduction from lock-in, and a 3.3% reduction from the direct impact. So you'll see in the green there, the confidence interval includes 0. So, you know, I wouldn't stake my life on the net effect being positive, but there's certainly, we're pretty confident that, you know, these are two opposing effects. And it may even be that the supply reduction is what's dominating right now. So there's a bunch of other analyses in the paper, some of which I've highlighted here, and I encourage you to check it out, including this last one about, we started looking into whether these sales are lost or whether we're having pent up demand that like it'll all get released at some point. So I keep your eyes peeled for an update that'll include that. One thing I wanted to have time to talk about is, along with this paper, we released some data sets that are available to anyone to use. One just is the data for recreating the figures in the paper, but the other one has aggregates of quarterly measures of the average existing rate, predicted new rate, their difference, which is the rate delta, distributions of the rate delta, what that means in terms of a payment change if you were to remortgage, both in dollar terms and percent terms, lock-in sensitivity, and then the percent and number of lost sales changed. We group that, you know, you can do that by MSA, by state, by county, by those loans type segments I had, home value buckets, income buckets, age buckets, race and ethnicities, LTV, and credit score. So, you know, we take seriously that our mission is to help inform the public, and you know, we hope this is useful to researchers and others who are interested in this topic. Just quickly revisit the research questions. You know, I won't read everything that's on the slide, but I think we've come up with what we think are pretty good quantified answers to those questions. But given this is a policy-focused panel, I wanted to spend the last little bit I had left here talking about some of the policy implications for this. Now, first thing I want to say is that this touches a lot of policy that's not even housing related, right? This is an impediment to the T-boat mechanism of foot voting. You know, there's lots of things that don't touch housing that are also policy related that would serve to be informed by the fact that we're going to have this decreased propensity to sell. But in terms of what do we do about this, a lot of this stuff is forward looking. But I think it is important to think about things even that are forward looking. I'm being told we're at time here, but we don't take a stance on what is the appropriate thing to do, but I think our paper does give us a lot of tools that we would need to assess the wiseness of each of these possible solutions. So I think that's my time.
All right, thanks, Jonah. Maybe we have time for one question. Eileen?
Just wondering,
Sorry, can you use the mic? Thanks.
so I was just wondering, like in your plot where you show like the effect of, or you look at sales under the ARM regime, it looks like there's no decline in sales in 2022, even in the ARM, in the fully ARM setup. And I was wondering, like, you know, even if like
This or the theoretical.
I think I saw it before. So I was thinking, I think it's closer to the end. It was just the figure showing total sales under an ARM regime and total sales under the regime that we have.
Oh, I see this one, yeah.
Exactly, the counterfactual. I guess like in your counterfactual, wouldn't you expect, even without lock-in, for there to be a decline in sales because there's like a shock to demand? And so, you know.
Yeah, so a lot, let me go to this slide, it probably shows this better. So if you decompose what's going on in the quarter by quarter sale rates, right? Using our model, right? The blue line is the lock-in effect. The yellow line is a seasonal thing. So this red line is like a quarterly fixed effect, right? So some of that, you know, the level of interest rates should get wrapped up into that, but that's certainly not the only thing going on, right? Like we kind of know why 2008 through 2010 was a bad time to buy a house, even though rates were very low in historical standards at that point. This is interesting, you know, things have, we went from it being a very great time for demand in 2001 and early 2022 to slightly less great. But, you know, if taken literally, that, you know, this would indicate that all things considered, right, there's still, you know, demand's still doing pretty well. You know, it's not as good as it was a year or two ago, but we're still in a relatively healthy demand side. Because rates aren't the only thing that get wrapped up into the quarterly fixed.
All right, thanks. So we have Erica Jiang next from the University of Southern California talking about the impact of credit quality policies.
Long-term appendix tables. Thank you for putting this paper on the program. In this paper, we study policies that aim to promote equal credit access. Access to banking and credit is crucial for regional economic development and growth, but it tends to be unequal across regions within a country. So to promote equal credit access, many governments adopted similar policies that leverage the financial resources of private sector institutions and regulate their lending in the underserved area. US government was one of the pioneers in making such policies. In 1977, the government enacted the Community Reinvestment Act, which mandates banks to lend to low-income neighborhoods in areas of their operation. So like other similar policies, the goal of the CRA was to steer private sector institutions' behavior toward broader broader social and economic goals. But private sector institutions are profit maximizing entities that are disciplined by market forces. So their incentives and capacity to comply affects the effectiveness of the policy. So after the financial crisis, we know they're having a lot of changes to the banking sector, and that revived the debate about the effectiveness of the policy, whether the policy actually distort the allocation of financial resources as intended, and what are some intended and unintended consequences of the policy. So as a motivating fact, here we plot the small business lending gap between the top 20 and bottom 20% counties in terms of income per capita. So we see that this lending gap has been rising since 2011, which coincides with the rise of non-bank financial institutions or shadow banks. So existing CRA studies mostly focus on within region analysis by comparing underserved and non-underserved neighborhoods. And that ignores the potential impact of the CRA on cross-region disparities. And neither could their findings help explain this trend. So what we do in this paper is that we empirically argue that the CRA widens cross-region disparities by affecting banks' branching decisions. So in particular, in high-income areas, banks subsidize underserved neighborhood as required by the CRA, and therefore CRA promotes equal credit access in those rich areas. But in poor areas, the regulatory compliance cost is too high. Banks cannot cross-subsidize neighborhoods without incurring losses. And therefore, what they're going to do is they're going to optimally close branches to bypass the rule. And the CRA-induced branch closure, therefore, leads to lending reduction, especially lending reduction in small business lending market, which is still heavily dependent on branches. And after the financial crisis, shadow banks expanded dramatically in the residential mortgage market, and such expansion increased the CRA compliance costs for traditional banks. And as a result, this expansion led to more CRA-induced branch closures, especially in those poor areas with more minority population. Those areas are more likely to be the marginal area that shifted from benefiting to suffering from the CRA. And as a result, the net effect of the CRA on lending shifted from a positive number to a negative number. And that attributed to the widened cross-region disparities in lending, banking access, and real business establishments, which I'm going to show you later. All right, so to provide some institutional background, the CRA requires banks to provide sufficient lending in the CRA designated underserved census tracts in their assessment areas. So for each bank, assessment area is defined as an MSA or counties in which the bank has its branches for deposit-taking ATMs. And then underserved census tracts are defined based on the median family income of the census tract as compared to the median family income of the broader MSA. So if the median family income in a census tract is below 80% of the MSA's median family income, the census tract is classified as underserved, and therefore lending to the census tract is eligible for CRA credit. Then banks are periodically examined for their CRA performance, and they receive a rating. If a bank receives a non-satisfactory rating, it's going to affect this bank's ability to participate in merger acquisition or to open new branches. It also makes the bank subject to more frequent CRA exams, which is shown to be costly, and also that hurts the reputation. All right, so based on those institutional details, I'm going to set up a very simple model. So there are three goals of the model. Number one, I want to understand how banks respond to the CRA. Number two, I want to use the model to illustrate the trade-off of the CRA and talk about its distributional consequence. And lastly, and more importantly, it's going to motivate the empirical measure design and also how we are going to evaluate the net effect of the CRA. Okay, so this is a very straightforward model. We focus on one bank's decision in one MSA, which consists of two neighborhoods, underserved and non-underserved. The bank decides whether to have a branch that serves both neighborhoods. And also it decides how much to lend to each neighborhood to maximize its total profit. And branching decision affects two things in bank's profit function. One is affects its markup, right? If I have a branch in this local area, since consumers really value having a branch nearby, that allows me to charge a higher markup. And second affects the regulatory cost, right? This is the key component of the model. If a bank decides to have a branch in this broader MSA, it needs to lend L bar to the underserved neighborhood as required by the CRA. Since L bar may exceed the private optimal level of lending, L1, therefore this is costly, right? So because there is a private level, optimal level of lending that banks wants to do given its profit maximization problem, but the regulation requires banks to lend beyond L1. And so this is costly, and how costly this is depends on, how costly this is may vary across banks. For example, some banks may have a higher cost of CRA violation if it has expansion plan or if it has reputation concern. And this variation is captured by delta. All right, so in equilibrium, banks decide to have a branch in this broader MSA if the benefit of having a branch exceeds the cost of having a branch. In a no CRA benchmark, there is no regulatory cost, so it's always beneficial to have a branch. But with CRA, banks decide to close a branch if the regulatory cost is too high. And the regulatory cost is going to be very high if the bank really cares about CRA compliance, if delta is high, or if the private level of optimal lending is far away from L bar, which is required by the CRA. All right, so based on this, I can make this plot of lending, which is the y-axis, against local fundamental, right? I want to use this figure to illustrate what is the potential distributional consequence of the CRA. I have 4 lines. The blue lines are lending in the non-underserved, in the rich neighborhood of MSA, and blue lines are lending to the underserved neighborhood, which are the poor neighborhood in an MSA. And the solid lines are actual lending under the CRA, and dashed lines are no CRA benchmark. Importantly, I have this a vertical dash line, which tells me what is the CRA-induced branch closure cutoff. Below this cutoff, banks find the regulatory cost too high, so regulatory cost exceeds the benefit of having a branch, therefore banks decide to close a branch. And above that, banks keep this branch. What we can see from this figure is in rich areas, banks provide more lending under the CRA to those underserved neighborhoods. So those underserved neighborhoods are subsidized. But in those poor areas, banks find it too costly to comply with the CRA. They close branches, and branch closure leads to lower reduction in both neighborhoods in those poor areas. And I can show with the same set of figures, I can vary delta. Remember, delta is how much a bank cares about CRA compliance. So in the right figure, delta is higher. So in the right figure, banks really care about CRA compliance. What we find by comparing these 2 figures is if a bank really cares about CRA, they're going to provide more lending to the underserved neighborhood in those rich areas. But at the same time, they're more likely to have CRA-induced branch closure. This gray area is bigger. Okay, therefore, this is what I mentioned earlier, that the CRA is going to widen cross-region disparity. Now, there is an empirical question whether the regulatory compliance cost is really high enough to lead to branch closure. I'm going to bring this to the data. So empirically, we want to exploit a shock to this lending gap, to the regulatory compliance cost. And we want to compare the branching and lending decision of banks with different delta in response to the shock. And our model predicts that in response to a shock to this lending gap, to this regulatory compliance cost, a bank that really cares about CRA compliance should be the first to close branches. And in order to implement this design, we need to first estimate delta. We need to first know which bank really cares about CRA compliance. So what our model tells us, if we compare a bank's lending to the underserved neighborhood and is lending to non-underserved neighborhood, we are going to get a function of delta, which is how much a bank cares about CRA compliance, and also a function of local fundamental demand difference. And how can we get rid of alpha is if we are able to construct a set of census tracts that have exactly identical demand, then we are able to just, by looking at the difference between banks lending to this 2 census tract, to get how much a bank really care about delta. So we are going to exploit this 80% discontinuity as imposed by the CRA. CRA says if a census tract's median family income is below 80% of the MSA's median family income, this census tract is underserved. So we are going to do this estimation for each bank by comparing its lending to the underserved census tract and not underserved census tract right around this 80% threshold. And we are going to estimate this for each individual bank where we restrict to the set of MSAs where the bank has branches. And we are going to do this estimation before the shock I'm going to introduce. Right, so we define banks with the estimated delta above sample median as high delta banks. So those are the banks that really care about CRA compliance, and we make this RD plot. What this plot tells us is that more banks, mortgage supply is about 2% higher in neighborhoods with median family income right below 80% of the assessment area's median family income. And who are those banks? So here we characterize those the high delta banks. First of all, high delta banks tend to have higher CRA rating exposed, so it confirms that we are capturing something meaningful. And also, they tend to have a higher need for structural changes like merger and acquisition, and also they have more branch growth during that sample period. But high delta banks do not seem to have higher profitability or differences. They do not appear to have different risk-taking behavior. They do not appear to have different technology, customer base, or any other characteristics. All right, and then we want to introduce a shock. Right after the financial crisis, shadow banks expanded dramatically in this period. We view this shock as a shock to local demand for bank credit. Right, as what I talked about earlier, banks with a higher delta should be the first bank to close branches in response to the shock. And we have some instrument for local exposure to the rise of shadow bank that I do not have time to talk about. Let me just show you some results. All right. So with this estimated delta, we find that high delta banks are more likely to close branches. And for a 30% increase in local shadow bank market share, high delta banks are 4% more likely to close all of the branches from this MSA. And this branch closure was accompanied by reduction in lending, especially in small business lending that is showing to be more branch dependent. Right, and for a 30% increase in shadow bank local market share, small business lending is reduced by 13%. And also this reduction in small business lending is persistent or is still robust when we look at this at market level, right? So it's not just like one bank withdraw and the other bank will step in. When we look at this at market level, there is still a reduction in small business lending. So that means that market adjustment failed to pick up bank level lending slack. And we repeat the same set of regression analysis using different county subsamples. We find that the adverse effects of the CRA concentrate in low-income areas with more minority population. And this, we have similar patterns across various branch and lending-related outcomes that suggest that those economically disadvantaged counties are more likely to be the marginal areas that shifted from benefiting to suffering from the CRA as shadow banks expanded. Okay, so now I show you there are some benefits of CRA. Some counties suffer from the CRA. Should we really be concerned about the adverse impact of the CRA? What we want to do is to put our empirical estimates back to the conceptual framework I showed you earlier and tell you what is the net effect. The goal of this estimation is to get what is the area under the curve. We add up the positive effect and the negative effect and want to understand what is the net effect. Right, so I don't have time to get into the details, but our empirical analysis tells us what is the lending reduction due to the CRA-induced branch closure, which is this distance. And we know the distance of this part, and we also know the functional form. And so we can somehow back out what is the cutoff, what is the CRA-induced branch closure cutoff. And what is the results? We find that about 40, so this is after the rise of shadow bank, this is the after financial crisis period, about 44% of total counties suffer from the CRA, and about 56% of counties benefited from the CRA, and as a result, the net effect is positive, is negative, is about 3.4% reduction in overall lending. But CRA was helpful before the rise of shadow bank. In this counterfactual analysis, we increased the demand for bank lending by 30%. We find that before the rise of shadow bank, the net effect was positive with about 30% increase in bank lending. And in total, about 43% of total counties shifted from benefiting to suffering from the CRA. And you can imagine that as shadow banks keep expanding, if we don't have a more adapted policy, the number of counties that suffering from CRA will be even larger. All right. So lastly, in the paper, we have some analysis to directly show some widened geographic disparities. We find the CRA rules are more binding in less economically developed areas as designed, right? The policy was designed to help those areas, but because of the effect we document, banks withdraw from those areas and more likely. And so we find widened gaps in economic outcomes between CRA binding and non-binding areas in terms of population living in bank desert, unbanked rate, small business lending reduction, and also some real outcomes. To conclude, sorry for taking 1 minute more. And so there are two types of policies that we can use to promote equal credit access. One is public scheme and the other is private scheme. Private scheme leverages the financial resources of private sector institutions. And we need to keep in mind that private sector institutions are profit maximizing entities that are disciplined by market forces. So our paper really just want to emphasize the importance of considering the supply side adjustment for assessing such policies. And I'm now going to read the last two bullets. Thank you so much.
Erica, any questions?
Hey, Erica, I was wondering, the function that you set up of lending relative to income, for intuition, it seemed like you use this linear function with these discontinuities. In reality, I would guess that the relationship between income and lending is nonlinear, right? So I could imagine the massive effects you find could partially be related to, say, the concavity of the relationship between lending and income, where those discontinuities are just at a really steep point in that distribution, which would affect maybe the interpretation or welfare effects that you calculate. Do you think that matters at all, or do you have I don't know if the facts that I just said are true even, but I'd be interested to hear what you think.
Yeah, no, I agree. I think if you really want to do a very serious quantification, one way is to really estimate what is the relationship between elasticity. So like, sorry, I say this is about income, but actually the model parameter is about elasticity, how profitable local area is. And I mean, you can do this in a more serious way. What we really want to emphasize is there is a simple framework for us just to think about what is the net effect, and also how exactly we can link the empirical exercise to this model parameter, which is the reduction in lending at the cutoff, right? But I agree with you. Yeah, someone can work on a more serious quantification.
One more.
Yeah.
Thanks so much, Erica. Super cool paper. I have one question about deposits. So where are the deposits going? And I know that probably the shadow banks take over the mortgage lending, and that's the profitable part that makes banks move out. But is there still room for them to have a deposit spread or any sort of market share power there?
Yeah, no, this is a very good point. So actually, the whole framework was from our previous model, previous paper, where we're thinking what affects a bank's branching decision is when you decide whether to have a branch, you trade off the marginal benefit and marginal cost. And the marginal benefit will come from all of the markets that were served by the branch, right? You would have different type of lending market. You would also have deposit market. But now the question is, given that you were already at the equilibrium before the shock, now there is a reduction in lending in one particular product market, that's going to lower the marginal benefit of having a branch. And so in some senses, the deposit market is going to get hurt because of the spillover effect. And not only deposit market, right? We show that a small business lending market is also hurt because of that.
All right. So let's move to our very last paper. Josh Bosshardt is going to be presenting. Another FHFA representative on the credit supply channel of monetary policy tightening.
Okay, so yes, hello, I'm Josh Bosshardt, and I'm very happy to present this joint work with Marco DiMaggio, Ali Kabad, and Aymeric. So before starting, I'd like to thank the committee for including this paper. And please note, there's also a standard disclaimer. This work does not necessarily represent the views of Federal Housing Finance Agency. So this paper focuses on the effects of the recent monetary policy tightening on the mortgage market. So starting around the start of 2022, of course, the Federal Reserve began increasing short-term interest rates and signaling that it would start contracting its balance sheet, resulting in a rapid increase of mortgage interest rates from around 3 to 7%. And during this time, the number of purchase mortgages contracted by 13% compared to 2021. So the main question we consider is what channels drove the reduction in mortgage lending? So in particular, to what extent did it reflect demand channels, such as consumers avoiding the higher interest rates, or supply channels, such as a reduction in the number of qualified applications due to the higher interest payments. And so this dominant channel has important implications for the overall strength of monetary policy tightening, such as whether it depends on consumers' elasticity of intertemporal substitution or on underwriting constraints associated with the debt to income or DTI ratio. It also has important distributional implications. So at the individual level, we consider which borrowers were most impacted. And at the regional level, we consider the general equilibrium ramifications for local economies and outcomes beyond just mortgage lending. And so in short, we have kind of three main findings. First, we find evidence of a dominant credit supply channel, which is based on our inference that almost all of the reduction in mortgages was concentrated in those that would have had a debt to income ratio above underwriting limits. We show that the reduction was especially pronounced for borrowers with a tendency to experience high DTI ratios, such as minorities and low to middle income borrowers. And we find that MSAs with a high exposure to the DTI limits also experienced relative reductions in house prices and spending. So briefly stated, the paper contributes to themes in the literature related to transmission of monetary policy, housing and mortgage markets, credit accessibility in the U.S. mortgage market, and bunching and missing mass techniques in context of mortgage markets. So kind of the main question is what channels drove the reduction in mortgage lending? I'll spend most of the time on that. So we answer this question using the National Mortgage Database, which is kind of discussed briefly, but again, it's a 5% representative sample of closed and first line mortgages in the US maintained by the FHFA and CFPB. We focus on purchase loans for one unit, owner occupied site built properties and MSAs. And for this talk, I'll primarily focus on comparing lending in 2022 to the preceding years, but the results are robust to extending to 2023 as well. So our main hypothesis is that an increase in interest rates elevates DTI ratios towards underwriting limits, which effectively reduces credit supply. So to illustrate, this figure shows that from 2021 to 2022, there was a shift of DTI ratios towards thresholds at 45, 50, and 57%, where there are discrete declines in the massive originations. So the 45% threshold is kind of a soft limit associated with the GSEs. The 50% threshold is a strict explicit limit for the GSE loans, and the 57% threshold associated with FHA loans. So this is interesting kind of to start, but kind of a disadvantage is that it mixes the kind of mechanical effect of the interest rate spike on DTI ratios with kind of the responses by borrowers and lenders. So to kind of separate those, well, we consider a counterfactual DTI for 2021 originations, but hypothetically simulating the interest rate as if they were originated in 2022. So in a little bit more detail, we compute this counterfactual DTI for a given loan in 2021 kind of in the following steps. So we first compute the counterfactual interest rate as the observed interest rate plus the increase in the primary mortgage market survey from the origination month to the same month in 2022. And then with that, we compute the principal and interest payment using just the amortization formula as a function of the loan amount, the number of payments, and the counterfactual interest rate. And then we can finally compute the observed or the counterfactual DTA as the observed DTI plus the increase in the principal and interest payment divided by monthly income. So this results in an average increase of 5.8 percentage points. So this figure shows frequency of loans for 1 percentage point bins in the DTI ratio, where the green line corresponds to counterfactual DTI ratios for 2021 originations, and red line corresponds to observed DTI ratios for 2022 originations. So there's kind of a few regions that I'll focus on based on the proximity to the kind of indicated thresholds. So the first region consists of loans with DTI up to 40%. So these DTI ratios are kind of well below the lowest threshold, and therefore unlikely to be directly affected by the thresholds. And we find in this region that the distributions are fairly similar, with this kind of a net increase of just around 3.6% of the total number of 2021 originations. For DTI ratios from 41 to 45%, we do see a kind of a noticeably higher mass of originations in the observed distribution. So this modest bunching could potentially indicate supply-driven, like intensive margin demand adjustments as borrowers kind of try to avoid the DTI limits. But we don't find that it's quite as robust to some alternative constructions of the counterfactual DTI. And then, of course, the main kind of point here is that like almost all of the reduction occurred for loans with a DTI ratio above the 50% threshold. So this amounts to 18.7% of the total number of 2021 originations. So if we subtract out the a bunching beneath the thresholds, and this kind of results in a net effect of 16.2% reduction for loans that are affected by the thresholds. So then kind of our second approach is to augment the counterfactual DTI by explicitly incorporating like intensive and extensive margin adjustments in demand associated with the increasing interest rates, as well as other time varying factors. So the main benefit of the kind of controlling for these demand factors that affect the aggregate level of lending is that it helps to kind of confirm the magnitude of the response that's due to the supply factors. So this slide describes the construction of the demand adjusted counterfactual DTI. And so the black text corresponds to the steps for the baseline counterfactual DTI described before, and then the orange text corresponds to the demand adjustments. So one change is that we compute the counterfactual loan amount by applying the interest rate elasticity from the literature, as well as incorporating predicted changes in loan amounts associated with changes in income and house prices. And then the other difference is that we scale the distribution to match the number of loans with the DTI up to 40%, which again corresponds to the region that's unlikely to be affected by the constraints. So this is intended to broadly account for factors affecting kind of the overall level of lending, like changes in population and household formation. So this figure basically shows that like this demand adjusted counterfactual DTI is pretty similar, whether you compute it based on originations in 2019, 2020, or 2021. And then we can kind of summarize with this table where it shows the kind of the change from the counterfactual to the observed as a percentage of all the loans in the counterfactual for each of these kind of DTI regions for the baseline and the demand adjusted counterfactual DTI, for the different kind of comparison years. And the main point here is that the estimates are all pretty similar, with like the number of loans with the DTI above 41% decreasing in a range of 14.7 to 17.6% of the total number of loans in the counterfactual. So I probably will skip this for now, and then I'll talk a little bit about distributional impacts. So in terms of race and ethnicity, we find that Black and Hispanic borrowers exhibited a kind of around 60 to 70% greater reduction in the number of loans affected by the DTI constraints compared to white borrowers. It's kind of indicated by the last row of the table. And we also find that Black and Hispanic borrowers were about 60 to 70% more likely to have a counterfactual DTI above the 50% threshold. So this is consistent with credit supply channel kind of driving the difference. And then in terms of income, the left figure shows kind of a Winsorized frequency plot, indicates that almost all the reduction occurred for households with an income below $100,000. While the right figure shows that these households were also about more than twice as likely to have a counterfactual DTI above 50%. So I probably have like 2.5 minutes to talk about kind of the regional implications. We aggregate to the MSA level, and we compute exposure to the interest rate spike based on the fraction of originations in 2019 through 2021 with an observed DTI below 50%, but a counterfactual DTI above 50%. So this high DTI share basically corresponds to like the fraction that switches from below to above the cutoff. All right. And we run a cross-sectional specification where the dependent variables, the growth of purchase loans, house prices, or cash out refinances or spending. The regressor is just this high DTI share and kind of the list of controls. So our first dependent variable is purchase loan growth, and kind of across different like specifications with different controls and weightings, we find pretty similar results. So like a 10 percentage point increase in the high DTI share is associated with about an 8 to 10 percentage point lower purchase loan growth. So this is kind of consistent with the kind of the earlier findings, but at the regional level. Moving on to house price growth, we find that a 1 standard deviation increase in the high DTI share is associated with a 0.17 to 0.3 standard deviation lower growth of house prices. So this is consistent with kind of the lower amount of originations potentially tempering demand by potential home buyers. We find that the high DTI share is also associated with lower cash out refinance growth, which could be due to the lower house price growth. It could also be due to the high DTI share indicating underwriting constraints, being associated with underwriting constraints for cash out refinances. And finally, we find that a 1 standard deviation increase in the high DTI share is associated with a 0.2 to 0.26 standard deviation lower growth in credit and debit card spending. So this observation is consistent with their lower rate of cash out refinances, which are often used to finance consumption out of housing wealth. So just to kind of conclude, find that the reduction in mortgages during the recent monetary policy tightening was concentrated around underwriting limits for the DTI ratios, very consistent with the dominant credit supply channel. We find that it was especially kind of or disproportionately impacted minority and low to middle income borrowers, and that MSAs with a high fraction of the population facing these DTI constraints associated with the increase in interest rates had lower house price and spending growth. So, thank you.
Thanks, Josh. Any questions? Yeah, Lou.
Interesting paper. So I was curious whether this is mostly a point about the affordability for first-time buyers, because I would have thought that a lot of people who already have a mortgage, I think there's a number, I think I saw that in like a Freddie Mac publication, that about 70% of these borrowers are actually able to extend maturity when they're refinancing. So, they have on average like 20 years left, but then they take out a 30-year fixed rate mortgage. So they're amortizing the loan balance over a much longer time, which automatically reduces the payments, and that should offset some of the binding nature of the payment constraint.
Yes, that's an interesting comment. Sorry, it was, I guess the question just like, sorry, what was the question?
So is this basically like, are you telling us that rates have gone up and it's much harder for first-time buyers to buy a house because it's just much less affordable to them? There's a DTI limit to some extent, a binding DTI limit. Or is this about more broadly, right? Like I think the stock of all mortgages, like about 2/3 of new purchase mortgages are like refis. And for those, I'm a bit surprised that the DTI limit would be binding, because the vast majority of those, instead of taking out, if like on average, say you've got like 20 years left on your mortgage, would you take out instead of taking out a 20-year mortgage, which typically does not exist, you take out another 30-year fixed rate mortgage when you're refinancing. So you're effectively reducing your payments by paying them over a much longer period of time. So I'm surprised that they would be binding for those types of borrowers.
Okay, that's interesting. We haven't kind of explicitly like looked at that particular issue. I mean, we have looked at like if there's changes, kind of systematic changes in loan terms, in terms of looking at shorter term mortgages compared to 30 years, and we don't really see any changes in frequency of mortgages that are originated at those terms. It's a little different than what you're talking about, I think, but that's what we've done that's kind of related to that.
All right, one last one, David.
It's a lot of pressure.
You've got the, yeah, it better be good.
So the demand adjustment here, I understand, right, is the diffuse kind of Heinz-York adjustment on the loan balance target. Is there any, or could you add any like endogenous bunching to the model also? Because even though the target might have shifted by like 2%, right, for every % increase in rate, maybe if the DTI is truly binding, people could further adjust to the binding limit.
Oh, right. That comment, that sounds kind of consistent with like the sort of, you know, bunching below the threshold here. Maybe that's what you're talking about.
Yeah.
Yeah.
So counterfactually, you know, maybe not all the constrained borrowers would just not get along, right? Maybe they bunch more. Right, they increase their bunching. You know what I mean, yeah, we can.
Okay.
We can talk.
That's fine.
Okay, well, so we're all done. Just before you go, I just want to say thanks to everyone for being here and participating online as well.